Hello everyone and welcome to episode number 53 of Just Diary of Cigar Time. I want to begin today's podcast with a big thank you to everyone for all the support I've received from all of you throughout this whole time. It has really been helpful in keeping me motivated to continue doing what I do, especially now that we seem to have reached what it might be the climax of the AI bubble this week, with the earnings release from Nvidia. Today, I'll make a few brief comments on that, then try to analyze what the potential future consequences could be going forward from the latest events. Because now that Nvidia's earnings are behind us, the matter that is going to become the center of everyone's attention is going to be the JPY carry trade. Something that, despite a few brief moments in the spotlights when everything was falling apart because of it, especially last year, then slips back into the shadows and nobody cares about it anymore. Well, you know what? We're back to that point where the JPY carry trade can really do serious damage and create significant volatility in the financial system. And this comes at a juncture that couldn't be more difficult for other central banks to step back and support the efforts of the Bank of Japan to keep this whole house of cards together. So before we dive in, if you enjoy my content, don't forget to like the video, subscribe to the channel, and turn on notifications so you don't miss any future updates. Okay, let's start with Nvidia, because even though I just published a detailed article on it, it's very important to talk about the market reaction to Nvidia earnings and where we might be going from here. The market reaction has been incredibly remarkable. For those who follow me on X, where I post regularly throughout the day, I kept saying there would be no real sustainable jump just because Nvidia beat revenue and forward revenue expectations that are systematically crafted to beat expectations. And that's exactly what happened. Why? Because algorithmic trading reacts to headlines. It's impossible for trading algorithms to scrutinize, analyze, and really going through the full filings in real time. There simply is no technology yet, and to be fair, I don't think there will be for several years, even with all these large language models. Because ultimately, there is that subtle element of human interpretation that matters a lot in these specific circumstances. So the trading algorithms reacted exactly as expected. Earning beat, pump. Everyone is safe, yada yada yada. Everyone is cheering. Okay, fine. Then human beings started going through the earnings, and frankly, it didn't take long to figure out that there was a huge discrepancy between the narrative Nvidia keeps pushing, overwhelming demand, GPUs flying off the shelves, data centers mushrooming as if there is no tomorrow, and the actual numbers they reported. In particular, how can you claim your GPUs are flying off the shelves when, in reality, finished goods inventory is up 109% year to date? They are literally stacking up. So it took a little time for real people to digest exactly what happened, and I'm not surprised at all that they didn't like what they saw. You might ask, why didn't the market crash right away at the open? Very simple. Nvidia stock had gap up massively in after-hour tradings on Wednesday. All the momentum trading strategies jumped on top, went risk-on, and piled into position across all the AI stocks, lifting the markets as a whole. There was a huge amount of buying orders and a massive amount of fear of missing out from retail that needed to be digested at the open. Once those buying orders were absorbed and everyone was already popping champagne, that's when the selling started to overwhelm the buyers. The results? The largest company in the world swung from plus 5% intraday all the way down to close at minus 3%. It is literally trading like a meme stock now, like it or not. These kinds of wild swings are not supposed to happen in something solid, in something well established, in something people truly trust. So perhaps this swing is the ultimate sign that something has finally broken in the blind conviction the market has shown so far in whatever Jensen says. And honestly, that's not a good thing in the short term. But don't worry too much yet. Unless the Bank of Japan, as we will discuss in the next chapter, recreates the damage it did last year in August and breaks the entire market structure again, this bubble is not going to nuke straight to zero overnight. Like all bubbles, there is a period in which the realization that something was very wrong and that everyone ignored it slowly spreads across all the people who supported it. Moreover, We are at a very specific historical juncture where this bubble has become overwhelmingly fundamental for the GDP growth of the biggest country in the world. As I said in the last podcast and in Trump's dilemma to bail out or not to bail out the AI bubble earlier this week, guys, if you think the US government, after propping things up so much already, is just going to sit on their hands and watch this unfold doing nothing, you have literally been living under a rock these past years. They are going to do something. Likely, they are already working on it. If the AI bubbles deflate slowly, the ecosystem can probably digest it and move on. What they absolutely want to avoid is a sudden break in the world market structure, because extreme volatility is the one thing that can really damage an ecosystem beyond repair. So what should we expect right now, in my opinion? If the government makes a big move, I wouldn't even be shocked to see people go nuts again and we print new all-time highs in the high stocks, depending on the magnitude of the bailout, the intensity, and how much backing the government gives it. If the government only gives mild support because it's afraid of the political fallout, then you might see a faster deflation of the bubble. But remember, things never move in a straight line in markets. In order for a bubble to fully deflate, you need to be prepared for massive retracements and huge relief rallies along the way. There will be points where people start calling a bottom. Everyone piles back in because the memory is still so vivid that this thing always recovers. It's going to be amazing again. People don't let go of their thesis that easily. Hope remains strong for a very long time. And so on, until the moment people stop calling bottoms and you get the ultimate washout. After that, the real bottom forms, and it will need significant time to consolidate because at that point, nobody will want to touch these stocks even with a 10-foot pole. That's how market psychology works. You need to be very careful. I'm just sharing my views and information here. Depending on your style, your risk tolerance, whatever, everyone is free to do what they want. Please feel free to take advantage of the situation if that fits you. Personally, as I've been doing for years and I will continue to do, I'll just sit it out. I sleep perfectly well at night. I have other investments that are doing very well, if not even better, and I am around for the long run. I'm not here to buy a lottery ticket and then, if things go wrong, get wiped out, because that's what happens when you hold lottery tickets. At some point, the numbers are called, and if you don't have them, you're done. You lose the money. And if you spend all your money, or worse, borrowed money to buy those lottery tickets, then the game is really over. Now, let's move to the second big topic of today's podcast, the JPY carry trade. Something that got completely forgotten while everyone was distracted by the hope that Nvidia would save the world, while in reality, things all around were already shaky because of Japan. What is happening right now is exactly what I warned about a few months ago when Prime Minister Takaichi was confirmed as the new leader. Let me read you literally what I wrote back then in Will Sane Takaichi last longer than a head of lettuce? Even if the BOJ keeps implementing yield curve control as it is already doing, without admitting it officially though, the JPY will quickly depreciate towards 160 against the US dollar. And that's the area where an outright FX intervention in the markets will be needed. That will set Japan markets in the exact same situation of 2024 that preceded the stock's flash crash on Monday, the 5th of August. As am I recording this podcast right now, after the Japanese market closed for the week, you can already see very strange moves in the US dollar JPY pair and across all pairs involving the JPY. I already flagged on X that this abrupt move in what is normally a very quiet part of the week looks like a clear sign of Bank of Japan intervention. Clearly, they didn't learn anything from the mistakes they made last year. They are literally using the exact same playbook. So, how is this likely to evolve? The level of damage will be directly proportional to the amount of volatility these interventions trigger. Don't forget though, because these interventions only provide very brief relief, they just push the market temporarily to another level. In the medium to long term, the JPY will keep appreciating and Japanese yields will keep going up. This is just short-term relief before an even bigger pain later. If things play out the way they did last year and in previous interventions, the first margin calls will trigger in the FX and carry trade markets. People will have to reduce leverage, but to reduce leverage, they need to sell assets. The assets they hold are mostly foreign government bonds, the safest part of the trade, stocks, derivatives, and other speculative positions. Which ones do you sell first when you're forced to deleverage? You don't sell the safest one first. You sell the riskiest one first, right? Long story short, it can trigger a domino effect that cascades quickly and ultimately forces the hand of the Federal Reserve. And the Fed, after the latest jobs report, is now expected not to cut rates again in December. As a matter of fact, the odds have come down sharply, and is another reason why markets have been reacting badly after the jobs report. However, things can change quickly, and like they did last year, they may even tip media to let market believe there might be even an emergency rate cut. Who knows? At the end of the day, all you need to reassure people is a news, and then if things recover, no need to do it. And if they don't, then you just go ahead and you're fine. So now, several dangerous dynamics are converging at the same time. Bursting AI bubble, a major economy, Japan, is on the ropes trying to avoid monetary implosion, and the risk is that this implosion will reverberate very quickly throughout the globe because of the JPY carry trade bust. Personally, I think this is not the last rodeo for the Bank of Japan. There is simply too much at stake. Other countries can really push back and significantly punish Japan for the damage it causes to their own financial system, because everyone understands that Japan needs to keep its real economy on a stronger footing. Otherwise, if Japan implodes, everyone else goes down with it because of the JPY carry trade bust. So Japan needs to remain standing, even if that quote-unquote standing means a slow deterioration of their own wealth, well-being, and economic prospects. But who cares, right? It's for the benefit of the global system. Until the Japanese population finally says enough, we'll probably keep going like this. So let's be very careful with everything I said today. Let's be mindful. Be prepared for bursts of extreme volatility, because that's exactly what happens when things start to roll over. If you haven't taken precautions so far, my personal suggestion is to use these last relatively calm hours wisely. And remember, better to be safe than sorry. I hope today's podcast has been helpful to all of you. Thanks a lot for everyone's support on X, on Instagram, and for reading my research on justdario.com. I wish everyone a nice weekend, and I will talk to you soon.